You're scrolling through your investing app at 11 p.m., watching a number go up and down, and you feel this weird combination of pride and panic. Pride because you're finally investing. You're not one of those people anymore who just talks about it. But panic because your credit card bill is due in 4 days. You got $86 in checking, and you're pretty sure your car registration expired last month. You wanted to feel like you were building something. Instead, you feel like you're juggling chainsaws in the dark. If that's you right now, listen to me. You're not bad with money. You just got the order wrong. And the order problem is way more dangerous than the picking problem. But nobody talks about it because it's not sexy. It doesn't get clicks. And it definitely doesn't make financial influencers look like geniuses. Quick thing before we get into it. I'm not a financial advisor, and this isn't personal financial advice. I'm just some nerd who spends way too much time looking at how money actually works in real life. If you're making big money moves, talk to a qualified professional who actually knows your situation. Here's what messes people up. The entire financial internet is obsessed with what to invest in. Buy this ETF. Here's the next 10x stock. Real estate is the only real wealth. But almost nobody is asking the brutally boring question that actually determines whether you build wealth or just stress yourself into an early grave. What should this next dollar do first? That's the order problem. And getting it wrong doesn't just slow you down. It traps you in a cycle where you're technically doing the right things while your life gets progressively more chaotic. Here's the part that makes me mad. The system we're all operating in has a default setting, and the default is what I call the one-pile default. Money comes in, goes into one account. You spend from that account. Whatever's left over, if anything, is what you can invest or save. That sounds normal, right? That's what everyone does. But there's a catch. The one-pile default assumes you have margin. It assumes you can absorb surprises, that your car won't break down, that your kid won't need emergency dental work, that you won't get sick the same week rent is due. And for about 40% of Americans, according to the Federal Reserve Survey of Household Economics and Decision-Making, that assumption is completely wrong. They reported they couldn't cover a $400 emergency expense with cash or its equivalent without borrowing or selling something. So when you're investing from a one-pile system with zero buffer, you're not building wealth. You're building a financial Jenga tower. And the system loves it because every time that tower tips over, you pay. Quick math. Let's say you're investing $100 a month into your Roth IRA. Good job, honestly. That's more than most people, but you've got no emergency fund. 3 months in, your car needs $600 in repairs. You don't have $600, so what happens? You either stop contributing to catch up, or you put the repair on a credit card at 22% APR. That's $600 repair, if you're making minimum payments. Costs you about $780 total after interest. That's $180 in interest, which is nearly 2 months of your investing contributions just evaporated. Now watch what happens next. 6 months later, you overdraft twice because timing didn't line up. That's about $54 in fees. A year after that, you have to pull $2,000 out of your Roth IRA early for another emergency, and now you're eating a potential 10% penalty. That's $200 gone. Add it up. $180 in credit card interest plus $54 in overdraft fees plus $200 in early withdrawal penalties equals $434 in penalties for not having the order right. And that's just in one 18-month period. The math isn't mathing because the order is backwards. So here's the counter move. Instead of thinking about your money as one pile you draw from and maybe invest from, think about it in 3 distinct layers. Layer 1 is the floor, stabilization. Layer 2 is a shock absorber, your buffer. Layer 3 is a growth engine, building. Most people try to build layer 3 while standing on quicksand. They skip straight to, I'm an investor now, without stabilizing the floor first. And the floor is just this. Can you make it through 1 single month without a crisis? That's it. Not 6 months of expenses. Not even $1,000 yet. Just, do you have enough in an account you don't touch so that if your check engine light comes on or you get hit with an unexpected bill, you don't spiral? For most people, that's $500 to $1,000. That's your floor. It's not exciting. It doesn't compound at 10% annually. but it stops the bleeding. I can already hear the comment section. But Mike, my credit card is at 24% APR. Shouldn't I pay that off before I save anything? Fair question. Here's why the answer is more complicated than the math says it should be. Pure math says yes, attack the highest interest rate first. But humans don't run on spreadsheets. If you put every single extra dollar into debt with zero buffer, the first time something breaks, and something will break, you have two options. Stop paying extra on the debt and lose momentum, or add more debt to cover the emergency. Both options wreck you psychologically. You feel like you're failing even when you're trying to do the right thing. But there's a catch. If you build a tiny $500 floor first, you create a psychological firewall. Now, when the car breaks, you're annoyed, not panicked. You don't spiral. You don't feel like the universe is punishing you for trying. You handle it and keep going. The Federal Reserve found that households with at least $400 in liquid savings were significantly less likely to experience financial hardship after an unexpected expense. It's not about the amount being huge. It's about it existing. So here's what you do. Open a separate savings account, not the one attached to your checking. A different bank if you have to. Name it floor or do not touch or emergency only. Make it annoying to access. Put $25 to $50 a paycheck into it until you hit $500. If $25 feels impossible, start with $10. The amount doesn't matter as much as the habit of feeding this account first. Once you hit $500, stop. Don't keep growing it yet. Move to layer 2. Here's the wild part. Most people who build this floor never actually touch it, but just knowing it exists changes their entire relationship with money. You stop checking your account balance with dread. You stop holding your breath at the gas pump. That's not motivational. That's mechanics. Cool, so you've got your floor. Now what? Now you build your buffer. This is where most people make the second mistake. They try to go from $500 saved to investing heavily without creating real breathing room. But there's a catch. $500 handles a flat tire. It doesn't handle a $1,200 ER visit, a $2,000 furnace replacement, or losing your job. Your shock absorber is 1 to 3 months of core expenses. Not your full lifestyle, your core expenses. Rent, utilities, minimum debt payments, food, insurance, transportation. The stuff that keeps the lights on and the car running. For a lot of people, that's $2,000 to $6,000. If you're a W-2 employee in a stable industry, 3 months is probably fine. If you're self-employed, contract-based, or in a volatile field, you want closer to 6. Some of you are probably thinking, Mike, this is going to take forever. I'm not investing for years at this rate. I hear you. That's real. But let me say it plainly. The hidden tax of having no buffer is way more expensive than the opportunity cost of delaying investing for 12 to 18 months. Quick math. Let's say you're 28 years old. You delay serious investing for 18 months to build a $4,000 buffer first. You miss out on 18 months of market returns. Let's say that would have been $3,600 invested at an average 10% return over 30 years. That grows to about $62,700 by age 58. Sounds bad, right? But there's a catch. Now let's look at person B, same age, who skips the buffer and invests that $200 a month immediately. But over the next 18 months, they pay $400 in overdraft fees, rack up $1,200 in credit card interest handling emergencies, pull out $2,000 from their IRA early and pay a $200 penalty, lose momentum and stop investing for 6 months out of frustration. Person B spent $1,800 in fees and penalties, pulled money out of investments, and broke their habit. Meanwhile, person A built the buffer, never paid those fees, and then started investing consistently without interruption. By age 58, person A is ahead, not because they earned better returns, but because they didn't keep lighting money on fire. Okay, but now you get to invest. You've got your floor, you've got your buffer, and suddenly you have something most people don't. Permission to be patient. When you're investing from a stable foundation, market dips don't terrify you. You're not checking your account every day, wondering if you should pull out. You're not stress selling at the bottom because you need the cash for an emergency. You can actually let compound interest do its thing. And here's what messes people up about investing. The internet makes it sound like picking the right stock or timing the market is what matters. But the research from Vanguard and Fidelity shows that for most people, staying invested consistently beats trying to time entries and exits by a massive margin. A 2023 Fidelity study found that investors who stayed invested through market volatility from 2003 to 2023 saw average annual returns around 9.5%. Meanwhile, if you missed just the 10 best days in the market during that period, your returns dropped to around 5.4%. Let's say it plainly. Time in the market beats timing the market. But you can't stay in the market if you're forced to pull out every time life happens. That's why the order matters. Start with your employer 401k match, if you have one. That's free money. Take it, then max out a Roth IRA if you're eligible. Use a target date fund or a simple 3-fund portfolio if you don't want to think about it. Notice what's not in that list. Individual stock picks, crypto, complex option strategies, or the next big thing. You're not trying to beat the market. You're trying to participate in it consistently. I can already hear some of you. But Mike, what if the market crashes right after I start investing? Here's the thing. The market will crash. Not if, when. It happens every 7 to 10 years on average. And every single time, people panic, sell at the bottom, and lock in losses. But there's a catch. Every crash in market history has been followed by a recovery. The S&P 500 has had an average annual return of about 10% over the last 100 years, including the crashes. So here's a counter move. When the market drops, you keep contributing. This isn't bravery, it's mechanics. You already built layer 1 and layer 2, so you're not forced to sell when things drop. You can wait. Let me show you what this looks like in real life. Person A is 26 years old, $45,000 salary. They read online that they should be investing, so they start putting $150 a month into a Roth IRA immediately. No emergency fund, no buffer. Year 1, they invest for 8 months. Then their car needs $900 in repairs. They stop investing. Takes 4 months to recover. Year 2, they restart. 6 months in, they overdraft twice. Costs $54 in fees. They pause again. Year 3, medical bill hits. They pull $1,200 out of their Roth and pay a penalty. By age 30, their account value is around $5,200. They're frustrated, burn out, and feel like investing doesn't work for people like them. Person B, same age, same salary. They spend 8 months building a $500 floor, then 14 months building a $3,000 buffer. They don't start investing until month 22. Then $150 a month into a Roth IRA. When their car needs repairs, they pull from the buffer, feel annoyed but not panicked, rebuild it over 3 months while still investing $50 a month. By age 30, their account value is around $6,100. More importantly, they never stopped, never pulled money out, never paid penalties. Fast forward to age 50. Person A might have $80,000 to $100,000. Person B has $180,000 to $220,000. The difference isn't that person B found a secret stock. The difference is that they answered one boring question over and over. What should this next dollar do first? Here's a psychological trick your brain is playing on you. Investing feels like progress. Saving in an emergency fund feels like you're just sitting on dead money. That's your brain protecting status and identity. You want to feel like an investor, like someone who's in the game. And the system loves it because when you invest without a foundation, you're more likely to panic sell during dips, pull money out for emergencies, and pay fees and penalties. But there's a catch. An emergency fund isn't dead money. It's insurance you pay yourself. Think about it. You pay $100 a month for car insurance, hoping you never use it. That's $1,200 a year that's truly gone. But a $3,000 emergency fund in a high-yield savings account earning 4% to 5% is your money. Quick math. If you pay $30 a month in overdraft fees, late fees, and interest charges because you have no buffer, that's $360 a year. Over 10 years, that's $3,600. Compare that to a $3,000 emergency fund that costs you nothing and prevents those fees. It's not even close. If you've been blaming yourself for years because you can't stick with investing, I want you to hear this clearly. You're not broken. The order was wrong. Build $500 to $1,000 floor first. Then build 1 to 3 months of core expenses as buffer. Then start investing. 401k match, Roth IRA, max 401k, taxable brokerage. If you have high interest debt above 20%, here's the path. Build $500 floor first. Then attack the debt while maintaining that floor. Once the debt is gone, build full buffer. Then invest. You still build a tiny floor first because without it, you'll keep adding to the debt every time something breaks. Listen to me. If you're investing right now but you have no emergency fund, building your buffer is going to feel wrong. It's going to feel like you're moving backwards. You're not. You're stabilizing the foundation so that when you start building again, you actually build something that lasts. If you haven't started because you don't have enough, start with the floor. Pick a tiny amount, $10, $15, $25 per paycheck, and set a reminder to raise it in 3 months. You've gone from someone who will build financial stability one day to someone who already is. Comment, floor then buffer then build, if you're committing to getting the order right. And if you want to know where to keep your emergency fund so it actually earns something, watch this video next. The villain isn't that you're bad with money. The villain is that everyone told you to build a roof before you pour the foundation. Now you know better.